Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
Yeah, glad you are here with us as we talk about financial matters. Myself, my co-host, longtime business partner.
Yes.
We've been doing this both financial advisors.
So last week I had mentioned in I guess at the beginning of the show that I wanted to talk about these high-yield municipal bonds.
Oh, and you never did.
We never got to it. We got tied up in other conversations.
The fake tease.
It was a fake tease.
Yeah.
And for that, I apologize.
Yes.
That I enticed you with such a incredible topic that you listened to the end of the show about high-yield muni bonds. So I thought this was an interesting, really super interesting concept that applies to many asset classes. But
what's the concept?
Is that because these high-yield municipal bonds that are sitting inside of ETFs and mutual funds don't trade very often, right?
So let's step back. Municipal, these are municipalities
that
raise money by issuing bonds.
Yes.
They become high yield when they're not. There's some question of whether they're going to be able to repay these bonds,
or pay them back on time, or just the credit quality
Yes.
of the issuer, and therefore the interest rate is higher than you would normally receive because of the fact
there's some risk there.
There's some risk there, and so people sometimes will just reach for yield. You hear it all the time, like, "What's the yield? I need yield.
I
What's
need
the
high
yield?
I need yield. I'm retiring.
I need yield," without understanding the underlying risk. And as if you know from our show, everything is risk-adjusted returns. Well, these things are so thinly traded.
Well, a lot of these municipalities aren't that big. There's lots of
little sanitation
or
districts,
universities too,
little
colleges, all kinds of little districts.
Little
this district,
districts,
that district.
Yes, and a little water district that has 3 employees, or a park and rec.
And when they go to
district.
sell they say we're going to issue a bond, a $50 million bond, let's say.
10 million, 20 million.
They go to issue it, and it might be a couple mutual fund companies might snap up the whole issue, right?
A lot of it, yes.
And so.
And then they don't trade.
And the bond market is so much larger than the stock market, and it's
not nearly as efficient.
No, because
as this will demonstrate, right? As this will demonstrate. So all of a sudden, the portfolio prices at one level in these ETFs because they have no.
How do you know what this is actually worth?
Yes, because it hasn't traded in 6 months or a year, a particular bond in the portfolio, and then all of a sudden it trades inside of the municipal bond fund, right? You as an investor are going to get whatever it trades at, their price, their book value. It trades, and all of a sudden it's not worth half of what they priced it at in the ETFs. And it brings me back to,
how common is this?
In the high yield world, no one really knows because they don't trade that often, right?
So the challenge is you put money in some ETF that owns, you seek out a high yield municipal bond fund.
Which is fine.
You put money in there.
Thinking it's worth X. But because
and the portfolio
pricing,
managers might think it's worth X. They don't know. And if it's a small municipality, they can't take the time to sit and do a bunch of research on each individual holding.
Correct. But my point gets to is illiquid assets don't have to be 100% illiquid where you lack transparency to price. So as we've talked about on this show, non-traded REITs are illiquid. And so you think it's worth one thing until it prices. And then when it prices, bam, you realize it's not worth nearly as much. It happens inside of bond funds as well.
And have we seen big reduction in values of?
Not that much,
because they're really so highly diversified.
Yeah, correct. Because they're smaller portions. But it just this one that talked about bond sales for Buckingham Senior Living Communities, which was a senior living community that they got the municipality to sponsor.
How do they get municipal financing for a senior community?
Well, because the municipality may want to actually sponsor it, then hire an operating company to actually run it, because they feel they need a senior community in their neighborhood. And it's not on that is not that uncommon.
It's probably the other way around, Pat. A developer of senior community properties goes to some community and says, hey, you really would benefit by having this in your background. We'll put one in if you help us raise this money on a tax favorable basis.
So the point being is that,
i.e. government subsidized.
the bigger the fund that you're in, the more broadly invested it is. So this is the example they give is Easterly Asset Management's high yield muni fund in June cost $6, right? The share price tumbled to $3 because of a bond trade.
One particular fund?
But it was pretty small. It was pretty small, right?
But if the buyer who bought the day before might have done some research, what's the highest performing?
What's the highest yield?
Yeah, what is the highest yielding municipal fund out there? That's the one I want.
That's right.
And it might have had a 5-star rating.
But if you're going to these huge, massive, like Franklin Templeton or ETFs,
they got thousands.
You're going to. But at the same time, you're going to dilute that yield because they have a diversified portfolio. So the reach to yield, if you're right, I just Googled what is the highest yielding municipal bond.
It's going to be the one with the most risk. It's probably the one that hasn't
priced
repriced
in a while. So. Again,
and you look at it from that, it's probably the one that has not that doesn't take the repricing seriously.
Oftentimes, more information doesn't make an investor better. More information.
Well, this was good information.
I thought so. That's why I read it. No, by Googling something, my point being, I could just Google high yield thinking, I have had 3 or 4 clients in my career tell me I didn't understand it. The only thing that mattered were dividends and yields, not the underlying asset.
Well, and here's to take something else.
3 or 4 clients in my whole career. I had one guy insist that I had no idea what I was talking about. As long as you got the highest yielding
he was
bond or the highest paying dividend, I couldn't take him on this client.
Of course, he was foolish.
Yes.
Why would you? You just know what he's talking about.
That's right.
And telling you don't know what you're talking about. That's my definition of a fool.
Okay.
You're the expert and he's not. And
in this particular subject, if I was discussing another subject,
then you might be the fool.
I would probably be the fool.
But look, I remember back when I was taking on clients, this was actually years ago when we were using more mutual funds than ETFs. And it was more actively traded. I go back 25 years ago or whatever.
Which is what it was done back then.
Yeah. And it was easy that's when internet started making the information available, and so someone put together a portfolio. Are these all 5-star funds? And you remember this. So there was a battle because sometimes you wanted to recommend a fund that wasn't the 5-star fund because the underlying holdings and whatnot, you thought it's better
the
opportunity.
5-star funds was Morningstar at the time, which is a rating service, still around,
and it looked at historical returns.
That's right.
Well, we would look at underlying holdings and build portfolios. It's before the ETFs even came out. And sometimes a 3-star fund or 4-star fund would be our recommendation.
Because it was more likely to have higher returns in the future.
Yes. But I remember the arguments would get with people. Not arguments, but it was, to your point, sometimes more information is not always helpful.
That's right.
That was a situation where they thought they were doing their own research and their own due diligence, and I only want to buy 5-star
funds.
And sometimes I'd say, well, we're not the place for you. The easiest thing for me to do is just go and
pick the 5-star funds.
Print out last year's top 5 funds and sell you those.
Yeah, in 1999, right before the tech.
Exactly. Yeah, my point.
Yeah,
and the 5-star funds would have been the ones that had
heavily.
Yes, all heavily.
Janus funds. Do you remember the Janus funds? All 5-star funds.
Yeah, they were. That's right.
No one talks about Janus funds anymore.
They sold part of Henderson, Henderson, or are they just Henderson now?
I don't know. But they
were
have
a presence in Denver. There's a downtown building there.
In Cherry Creek. It was a spinoff of S&P Southern Pacific Railroad.
What was the railroad doing involved in the...
It used to manage their pension funds.
Huh.
That's where Janice came from. We all know that.
I didn't know that.
Yeah.
Thanks for the history lesson there. That useless trivia.
As did Sprint came from Southern Pacific Railroad. Sprint, the telephone company. Southern Pacific Railroad Internetwork Telecommunications, Sprint.
And there are times I wonder, why don't we use rail more for transporting goods? They keep taking all the railroad tracks out.
Is that what you think?
I do. Like every downtown's got the rail yard that they're redoing. They're taking out the tracks.
You're not saying that when the rail yard's coming in the Midwest when they're
it's coming in California, the bullet train.
Okay,
My grandkids are going to look forward. They can go from Fresno to Modesto.
Oh my God.
How do you get to Bakersfield from Fresno? It's going to be awesome.
We're a laughing stock. California's a laughing stock.
It's unbelievable.
It is.
Some of the stuff is unbelievable. You wait till gas is $8 a gallon in a couple of years because two more refineries just shut down.
That's good. Won't be.
And you watching Newsom trying to reinvent himself right now. It's really.
Oh, I know. It's just something. It won't be. Gas won't be $8 a gallon where I live.
Where are you living?
Not in California when it's $8 a gallon.
Is that your limit? That's the time you're leaving?
That's it.
And Kathy's really happy about that too.
We've discussed it.
When it gets $8, that's the time. We're selling our house.
Well, it's relative to what they're charging in other states. Okay, let's take some calls.
We're talking with Kevin. Kevin, you're with Allworth's Money Matters.
Hi, gentlemen. Thank you for taking my call.
Yeah. Thanks for joining.
So I'll be turning 60 here in a few weeks, and probably
happy
plan to
birthday.
retire. Oh, thank you.
That's an exciting one.
Yeah. Nah, I don't know about that, but it's exciting in that I'm planning to retire probably in the 2 to 3 year window.
Oh.
And I've got a pretty good nest egg with the 401. I've continued to aggressively contribute through that. And in addition to my 401 contributions, I've been contributing to a Roth IRA. But as I'm getting closer to retiring, pre-Social Security, I'd like to probably, delay that. I'm wondering if it would be better, instead of contributing to a Roth, to just start building up like a cash bridge, maybe like through something like Treasury Direct or what have you.
Well, here's the thing. You can take out your contributions to your Roth regardless of your age. It's just your earnings that have to wait till retirement time. And there's a 5-year clock that starts when you open that IRA, but you've already opened that Roth IRA. You've already opened.
So how old are your Roth IRA? When did you make your first contribution to the Roth IRA?
Probably about 2 years ago.
Yeah, it's a 3 year. You had a 3-year window. It's three more years.
Window, and
once it's 5 years.
Principal. Okay.
That's correct.
Yeah, so I would keep using that because you might not need that. You might, but you might not. But if you don't, you've got it in this nice tax favored vehicle.
And so how much money do you have in qualified dollars? 401ks, IRAs, that sort of thing.
Yeah, so like my 401k, I'm like between that all in, probably about $1.5 million, not excluding the wife. But then I was late to the Roth party, so probably only a third of that is after tax dollars.
Okay. So a third of it, so $2 million, and it's hard to exclude the wife if she's going to be included in your retirement.
Well, yeah.
So assuming
we're going to exclude the wife,
she's doing really well on herself too. She's a teacher, so she'll have her pension, and then she's probably got another $400,000.
Okay.
And Kevin, will you have a pension?
In a Roth. I will not. No. So I'll be strictly Social Security, which I'm hoping to probably delay to 67 at least.
All right, and the reason I bring this up is, right, you want to look at that bridge because the time between your date of retirement and the day you start Social Security is a really good time to look at Roth conversions.
Okay.
Right. So if you either build your own financial plan or
of this 1.5 million, if you were to retire today, how much do you plan on taking out a year from that to replace your salary?
No, probably pretty close to 80,000. Probably on the bottom end. Plus, when we retire, that's when I'm planning on some big expenses. Vacations or.
How much do you make
weddings,
now?
Kids. I make about 100. I'm in commission sales, so it can range from 80 to 160, 180.
And how old are your kids?
My kids are 25 and 26.
Okay, you don't have to worry about them financially anymore.
No, yeah, college is paid for. House is, a few months away from being paid for. So.
Okay, so house will be paid for as well. And do you plan on never going back to work, or you're just ready to this high pressure job, ready to call it quits? And
No, I'd like to keep myself busy with something. So.
You should pay for a
that's to be
financial plan.
determined.
yeah, have you modeled this out?
I have. I've worked with a financial advisor. I mean, we've modeled it out at the point where I just want to make sure I'm going to be okay, but tailored to a specific course of action, is still a little squishy.
Well,
That's
well,
you're
that's
a couple years off.
Yeah, but I'd pick a date and aim at it. I'd pick a date.
I'm sorry.
Work with your advisor and say, I'm going to retire this particular date.
Yep.
What does this look like? Let's assume what my portfolio is going to be worth at that time. Where's the income going to come from, and model it out.
Yeah, I'd pick a date. I would pick a date 18 months to 36 months in the future and just say, give me this number on this particular date if both myself and or my wife go into retirement. Or give them, look, I did it with my in-laws. My sister-in-law and brother-in-law, they were talking about retirement. They kept asking me questions, and I said, just go to an advisor. Happened to be an Allworth advisor. I'm kind of partial to them. Go to an advisor and show them everything you have, and then give them the dates that you both want to retire. They don't have to be the same dates. And they came back and said, we're not going to hit that date exactly, but we're within 12 months of that particular date. And it worked perfectly. He retired sooner and she retired later.
Because one of the risks you have is you're pretty young to be retiring, right?
Yes.
And you've had a pretty decent wage with your commissions and all, which is you don't have enough money saved up to replace that.
Right.
Yeah.
And I, you mentioned the Roth conversions, and I mean that's kind of top of mind, I think, for me, especially the first year or two. If I didn't have income, that would allow me to convert more, correct? Or
That's correct. But you also, how old is your wife?
Same age. We're within 3 or 4 months of each other.
And in retirement, how do you pay for medical?
Yeah, that would be, I think, that's a very good point.
She's a teacher.
She's a teacher, so she has retiree health benefits, and I don't know the pricing, if it would be beneficial for me to get onto her plan or just go out into the marketplace.
Oh, yeah.
The market's very expensive.
Yes.
Probably her plan.
And so I knew you had mentioned earlier that she was a teacher. You have to actually build that into the plan as well as what kind of benefits, health insurance. It makes it easier for you to retire, by the way, if you actually are covered under her retiree health insurance. Unless she stays, the best thing that could happen is you retire and she works till she's 75.
Yeah, I don't know.
He was excluding the wife anyway. So.
Yeah, he didn't exclude the wife in the retirement.
Yeah, these trips. No, I only need to plan with the cruise for one person.
I know. I'd save so much money.
I'll save so much money.
I am starting to
just dinner for one.
For like my monthly budget, I'm factoring that. I am factoring in, $1,500 a month for health insurance. I don't,
a good financial advisor will actually model this at a date and actually, and a good financial advisor would be highly concerned about the health insurance between the dates you retire and
and 65.
And yes.
Yeah. And, so what happens if your wife suddenly has an early death? What's that do for your medical?
So if you're engaged with an advisor now, just go and give them the actually very specific dates and then just target to that. And then it makes it so much easier to plan.
I will.
All right. Appreciate the call.
Yeah. All right. Thank you, gentlemen.
Wish you will.
Right, take care. Right,
yeah, it's pretty.
He didn't exclude his wife in retirement.
It's relatively young to be retiring.
Very young.
Turning 50 and planning on retiring in a couple of years.
Yeah.
We saw that in the 90s, and the stock market
60s,
kept going up.
yeah.
A lot of people were retiring younger and younger, and
for a while.
Then the markets fell. They couldn't afford it, and then they pushed off retirement. And now we're seeing a lot of people delaying retirement or continuing to do some sort of employment.
Yes, and large part of that is the health insurance is a driver.
That's right.
But the .com boom, do you remember the commercial with E-Trade where the guy was on a gurney?
No.
You don't remember this? He was face down on a gurney, was coming out of a room, and he had money coming out of his rear end.
No, I don't
You
remember
don't
that ad.
remember?
They were pretty aggressive in some of their marketing campaigns.
It says you have so much money, you'd have this problem, and they had a guy. They were going to operate on him because he had so much
Because
money.
he had an account at E-Trade.
He had an account.
They also had the babies. It's so easy
Oh,
a baby can do it.
yeah, for a while.
For a while. You don't see the name E-Trade anymore, do you?
No,
They got bought by somebody.
Morgan Stanley,
Hmm.
Smith Barney.
I can't keep track.
Something like that.
I can't keep
They were
track of
bought
them
by
all.
someone.
Smith Barney name still exists? I don't think so.
I don't know. No, I don't think so.
I don't think it does. I mean, there's been so much consolidation.
In the industry, and it will continue.
As most industries, and consolidation, that's part of what
Yes.
happens.
Yes.
Companies grow and they merge with other ones and continue to grow and all that stuff. But
Let's go to.
but no, medical's a big deal. And
it's
if you're
huge.
counting on your spouses, and if you're that young, you need to think, all right, what happens if something to my spouse passes away? You might need life insurance on a spouse for a period of time.
Oh yeah, yeah.
To ensure that,
You have
depending
to-
on your financial assets. Like the last call is a little tight, given
very tight.
the.
That's why we said specific date.
And run the models. 'cause
And run the
it
models.
Seems a little tight to me.
Yes.
Let's talk to Susan in Ohio. Susan, you're with Allworth's Money Matters.
Hello. Thanks
Hi.
for taking my call.
Yes, glad
Hi.
you joined us.
Okay, so I have two kids in their mid-20s who are both college graduates. They're working full-time. And I'm just trying to figure out the best advice to give them at this point for their financial future. One works in a company that has a 401k, so he's contributing to that. And he's done well already 3 years in his career, so he's saving a lot. And then the other one doesn't have a 401k. We've set up an IRA for her. Hopefully she's going to be getting a better paying job soon, but I don't know when that's going to happen. So we are just trying to, they're totally different. And so it's like, I'm sure there isn't like the same advice I should be giving both of them. But what would be the good parent thing to do?
Do they want your advice?
Well, that's a great question. I mean, we're not asking.
But so it sounds like right now, one of your kids, their career's doing well. They're making great money.
Mm-hmm.
They're saving well. You have no worries about their financial future. The other one,
I mean, probably not. Yeah.
The other one, you love just as much. Great person, but their career's not doing as well. They don't have opportunities to save, and they haven't been saving. They have opportunities, but they haven't been saving. And so
a little bit, yeah.
And so you've been saving, helping that child by setting some money aside for their future, right?
I mean, a little bit, right? I mean, right. I mean, we did that for both of them, and we paid for, both colleges and all of that, which, I mean, they say all the time that was the best gift you could have given us, because most of their friends have a lot of college debt. And so, we never wanted them to have to deal with that.
Oh, that's nice.
So, yeah, well,
it's nice that they recognize it.
And are you in a position where you have substantially more assets than you may need in your lifetime?
Oh, I mean, I wouldn't say that.
Okay.
But, no. I mean, we don't have any big chunk of money that we can pass along to them or anything like that.
So what is your question for, what are you hoping, like if you got off this call and said, man, I'm so glad I called those guys, what is you're hoping to gain?
Is there just like, this is what every, person in their mid-20s should be doing financially? What are the top three things that we should tell them?
Oh, is save 15% of their income.
Focus on your career.
Focus on your career.
Save 15% of your income. Avoid all consumer debt.
And marry well.
Okay. Oh, yeah. I love it.
That's when she said, "Oh yeah." That's funny. Yeah. Oh yeah.
Right.
Yeah. Let's save 15% of the income and focus on the career. But Scott has 4 children. I have 4 children. Mine are all my oldest is 30 now. It's some of them want your advice, and some absolutely don't care. Right.
Right. I mean, I guess it's not that they don't care. It's just we have so much time.
Different.
And so, the idea of compound interest is like you have so much time.
This generation looks at it a little different too. I mean, there's this kind of whole movement where they mini retirements where work for 6 years and then take 4 months off, 5 months off.
Yeah.
Which
Right.
I'm 58. If I would have did that, people would have looked at me like I was out of my mind. But that's it's not that common, but it's becoming more common.
So if she saves 15%, and if she doesn't have a plan available through her employer, then I would put it into a Roth.
She can do it on a monthly basis.
Yes.
She can set up something just gets sucked out of her checking account.
Because I assume her income's relatively low.
Right. I mean, it's not. I mean, it's low and it's not even full time. So she's still on my benefits. So it's like 30 hours a week, and then no benefits, and then it's not super low. But I think she's like, okay, I've got a year in now. I need to get more experience. I need to start looking for another job. But just having it like a percentage of 15%, I think is a good number because it doesn't seem outrageous.
No, and they're not used to having any money anyway. And what's her degree in?
Her degree is in graphic design.
Okay. Yeah, unfortunately, it's a tough field right now because of AI.
It is a tough field. Yeah,
AI has displaced. In fact, I was talking to our graphic designer a couple of weeks ago, and he had done an internal video, and he asked me if I could tell what parts of it were AI, and I could not.
Yeah.
He had still shots. He had still shots of an advisor meeting with clients, and he made the clients and the advisors interact with each other with no voice but movement by using AI. And it was an internal, and I don't know if they were real clients or not real clients, but it was internal. But anyway, different subject.
A part of this, so for you, Susan, saving and having financial security has always been important to you. It's one of your values. And
right. I mean, and that was something my dad instilled in me.
I understand.
He grew up with, no money at all.
Do you have siblings?
But he also didn't. I do. I have 2 siblings.
And are you guys all the same financially?
I mean, they're better off than I am.
Oh, okay.
I would say I'm good. I would say one is very good. And I would say one is very, very good. So, none of us are horrible. But it goes back to that marrying for money thing. So the one who's very, very good.
Okay. She married well. They married well.
Very, very well. Yes, right.
Come on.
Yes, exactly. And the other one has no kids. So wouldn't we all have a lot of money?
I mean, I have three sisters. We're all very different financially. Extremely different.
How you view money, not just your income, but how you view money.
All of it. And we had the same parent, right? And so I think, I have adult kids as well. And the fun things, it's always funny. You get new parents and they're all idealistic and, we're going to raise them this way. And then they're going to turn out like this. Right. And then when somehow the teenage years come and you realize their hopes and dreams for their life may not be your hopes and dreams for their life.
Right. Exactly. It's who they're around. Yes, exactly.
And
the good thing is our kids don't blow money. They're very conscientious. They don't overspend. They're not into the consumer things.
Nice.
I mean, neither one of them. They hate to shop. So, I have to say, I think you need new socks, so they're not running around blowing money like crazy. They're way more conservative than I am when it comes to spending. And I don't think I'm outrageous, but they're very conservative. So that's great. But I also just don't want, in 5 years, 10 years, oh, wow, is this all I have?
Yeah.
Or I want to buy a house and I should have been planning already. And,
well, the nice thing about the Roths is it actually allows you to do that because you can pull out your principal after the Roth's been established for 5 years. So just have them do 15% of the income in Roth and develop the discipline. At this age, you just want them to develop the discipline. So.
Yeah. And it's one of those things where, there are moments with my kids, I just hey, it's your life. You've learned. They're not going to learn anything new from me.
Yeah.
They've heard it all from me. What's if they ask my opinion, I'll give it to them. Otherwise, I try to just keep my mouth shut.
You spend a lot of time thinking about this, or?
Yeah, I want good relationships with my kids.
Oh.
I have thought a lot about it, and I don't want to spend a lot of time. They don't always take it.
Well, I only give the advice if they ask.
Yeah, that's what and if I saw something really serious,
yes,
I'd probably sit down and
you'd say, "Have you considered this?"
Yeah,
which is a nice way of actually giving advice.
Yeah, so my before we go back to next call here. my son, and I've talked about his poker playing in the past.
Yeah, but he's a pilot for JSX.
Yes, he's a pilot.
Which, by the way, I flew JSX a couple of weeks ago, and it was a little bit more expensive than Southwest, but
it's probably substantially more. Southwest, it's like every week the price goes up. And if you buy it, 2 days before, it's expensive.
We bought this relatively short notice, but it was one of the most enjoyable flying experiences I've ever had. We drove up to a hangar. It was a hangar, and there was a roped off area with some carpet and a couple.
Where'd you fly out of?
Reno.
Uh-huh.
Burbank was the hangar. We flew out of Reno. It had a little place there. It was kind of crowded. You just went and got your ticket.
You pull your car up and they valet your car, right?
Yes. They get your ticket. And then they screen you as you're getting on the plane. So they go through the screener where they're actually x-raying your
Those
bags.
are new screeners that require that
the
the other airlines quite foul.
Oh, got it, because it is a commercial airline. And then you get on the plane, and the seats are wide, and it was fast, and it was easy, and parking was easy, and it was comfortable.
Okay,
Anyway,
well,
JSX.
Good. I'm glad you gave a pitch
commercial.
for JSX, which I've not flown them, even though my son's a pilot. But he used to play quite a bit of poker, and he would make money, like have to on his tax returns, but it's actually a big chunk of his
income was
Yeah.
playing poker.
Well, and while he was in a pilot school, it was like his only source of income, and he made. So I asked him the other day. I said, and I know that he'd kind of starting to get burnt out on it. Was playing less and less. And I talked to him the other day. He says I quit playing. He says I can't play anymore because of the new tax law that's coming into it. And so in the One Big Beautiful Bill Act, you can
a little bit of this. How much you can deduct?
You can only deduct 90% of your losses.
And is that a big enough delta that it makes?
He said, I'm just going to make up some numbers because, even last year his margin was maybe 8%.
So he tracks all his play.
Oh yeah, 100%.
He takes it like a job, like that's his job.
Yes, of course. That's exactly what he said. I view it like a second job for me, and I figure I could make X dollars an hour. But if let's say your margin, let's say somebody gambles a lot, let's say they have $1 million in winnings and $900,000 in losses for a year. They made $100,000. Million in winnings, 900,000 in losses. You made $1 million.
Okay.
In the past,
but then you only get to deduct $810,000 of that loss.
Correct.
You only get to deduct. I didn't think about it.
So
like that.
you're
Okay.
taxed on you'd be taxed on $80,000. He says he's one of his buddies he says there's no way my tax bill
because their margins aren't that large.
My tax bill are going to be more than what I
got it. So if you run at an 8% margin,
I mean, it just wiped out
a large portion, unless you have big wins, but that's not how they play.
Because you're going to have big losses. And you might have, he was talking about, he has a lot of friends that are professional card players, and they might have a couple years where they make huge, and they might have a full year where they're at a loss. And if you can't deduct all your losses, it's completely changed. This must start next year. I don't think it starts this year, but it's one of those things. I don't know how that got pushed in there. I'm not a big fan of professional gambling.
But again, back to you telling your kids what to do.
No, it's my son. I love my son, and I was hoping that this would play its course, and it's just kind of
Well, it has. The government mandated it.
Yeah. Well, I just like win-win-win. I like business transactions where everybody wins.
Yes.
Not where it's a win-loss, which is how
gambling
poker is.
It's interesting. It will affect. I did read an article where they said it will definitely affect gambling centers, including Indian casinos and Las Vegas and a couple others.
It can't. They have to repeal that piece of it. It'll destroy it.
It would destroy that industry.
Destroy it.
Yeah. Yeah, you
whether you agree with it or whether you like the industry or dislike the industry. I mean, you could tell someone you can only deduct some of your business
That was
expenses?
the article I read. It talked about how there's no taxes on tips, but the fact that this will be offset because there'll be less people coming to Vegas to tip.
Yeah,
That was
it
the
has
thesis.
to. I mean, I don't know how much the casinos make off those kind of. I don't know where their real money is because these are when you're playing poker. I think the house just gets. I don't know what
They get a percentage of the. I don't know. I don't play poker.
They get
but
something.
My
But
understanding
they
is that they're not in the pot.
They're not taking the winnings though. Yeah. Anyway, why did I start talking about that?
I give up.
We're talking about kids. Well, it's the big beautiful bill act.
Yes.
Yeah.
Big beautiful bill.
And we're talking now with Nancy. Nancy, you're with Allworth's Money Matters.
Hi, thank you for taking my call.
Sure.
I'm a longtime listener.
Oh, good. Thank you.
I have a couple of questions, but the first one is, have you two changed your opinion about cryptocurrency now the Genius Act has passed regarding stablecoin? I was kind of wondering how you were feeling about that.
That's a great question. I get the thesis behind the stablecoin. It just, in fact, I was thinking
the Genius Act was a bill that was passed to put some regulation on cryptocurrency.
Yes,
and primarily stable coins.
And stable coins. So
they're almost like banks and.
Yeah. So what? Let's
Without the
describe
multiplier
for the
effect.
rest of the listeners what a stable coin would be. One is if I had a coin that was in an account and I owed Scott some money, rather than use the financial the current financial situations in order to get that money, I actually could just give him access to the stable coin and move some stable coin over to him, and rather than
instead of
dollars.
using Venmo or Zelle or PayPal
or dollars or writing
dollars,
a check or doing an electronic funds transfer. So I was thinking about this. It's funny you asked because yesterday I was on a bike ride and I was thinking about stablecoin, and I thought, where does Intel come up with a stablecoin? Does Microsoft come up with a stablecoin? Does Apple come up with their own stablecoin?
Or
Amazon come up with their own stablecoin? And then we all then start transacting in all these kind of different currencies that are all pegged to the dollar.
Mm-hmm.
And then what is the regulatory, which was what the idea behind the Genius Act was, is to create a framework for this regulatory environment that fits it.
There's a lot to be worked out in this whole thing.
Yeah, the fits. Yeah, correct. And then how does Apple make money? Do they make money on the carry, or meaning people put in dollars and then they invest those dollars in treasuries and then they get the interest rate on it?
I think that's how it's structured.
But then at that point in time, then why would I want a stable coin? Why wouldn't I just want to keep my money in treasuries and just
that's what I
transfer
had. I haven't.
Right? Because why do I want to give that carry or the interest rate that particular currency to Apple or Amazon or to anyone else? Why wouldn't I want it for myself? Which is why I keep my bank balances at a bare minimum. So what do I think about it? I think about it. Obviously, I've thought about it a fair amount. I haven't.
You're unsure of what the future commercial application is going to be.
That's correct.
Right.
Thank
and
you.
whether that's going to be of tremendous benefit or negligible. And from an investment standpoint, you don't think, well, I should invest in these new companies that are putting out stable coins.
No.
Because there's plenty of other good investment options in the universe that exist today.
And correct. And then what happens, it's the same thing that you look at the history of credit cards, right? All of a sudden, one credit card offers more points and miles than another credit card, and then I start using that. What will happen in this over the long term is that will happen with stable coins too, which is, okay, we offer 3% interest, or we offer this, and they say, okay, we don't allow you to offer interest. Maybe.
Didn't the bill say there's no interest?
Yeah, but then maybe something else of value, or maybe they're tied to Amazon, or maybe I get a 20% discount when I buy, tape at Amazon, and they deliver it to my house with the rest of the stuff we buy every day.
The 3 deliveries a day.
I actually took some paint and marked off a place in the street for the Amazon guy to park. It just says Amazon right there.
No, he's got his own parking place.
He's got his own. So what are your thoughts?
Sounds like I'm not going there.
Really?
No.
I just went there for you.
You're
You
not
won't
going
go
there on your thoughts?
Well, I'm going to give it time, that's for sure.
Well,
Okay, all right.
you're not all that positive about it.
No, I am not.
I think it's ripe for fraud and corruption.
And so they're trying, at least the government regulation is trying to prevent some of that. That's really what it's about.
I will not be using this stable coin anytime soon. Let's just put it that way.
There's no need to.
Yeah, I was thinking about, and why would I put something in a non-interest bearing?
But if Amazon, if you had a 3% discount on all purchases, if you used their coin, you probably would use their coin.
I might. Yes. Yeah.
But right now, there's no commercial reason for you to do so.
That's right. But if you think about how, like, how government works and the regulations, like what, like if I was talking to a friend. I'm going off path here, but it just is an example of how the government actually sets up things and then businesses like figure their way around it, which is why is your health insurance provided by your employer? Right? Does anyone, why is that?
Because during World War II, they weren't allowed to increase wages. And so companies got around that by offering fringe benefits.
Right? Exactly.
Government intervention. Yes.
Government intervention. And which is both a negative and a positive, which is why we're so optimistic about U.S. companies in general, which is there's a bunch of smart people that find their way around problems in order to make money, which is,
And I believe they weren't allowed to increase wages to entice new workers.
Thank you.
They could increase the wage. I don't know exactly the rules, but
all right. So that's our view of that. Did you have another question for us, Nancy?
Do you have time for another question?
Oh, yeah, all the time. I'd talk to you. The mere fact that you wouldn't answer the question about the Genius Act compels me to want to know what else you don't want to talk about.
Okay, this one is regarding when Trump replaces Jerome Powell in 2026. Most likely it's going to be a yes man. Okay, that's going to be the Fed chair. So I'm thinking, is now a good time to start maybe making some changes to my portfolio since the market's doing very well? This person, whoever he appoints, is going to be the Fed chair for 10 years. So even after Trump's out of office, that person's going to be in control. So I'm not sure.
Yeah.
I know you always say
there are certainly some things I don't agree with Trump on, and this whole area of Fed independence is one. But the markets are not worried about it.
Yeah, but we don't have a new Fed yet, a new Fed chairman. So.
Oh, and what's your portfolio look like today? How much risk is in your? How much do you have in equities in it?
Okay, so we have about maybe 65% equities and 35 in bonds.
Okay.
And are you taking income from the portfolio?
No, this is just our IRAs, and we will have to start withdrawing in 2 years. My husband will be 73.
And you're retired today?
Yes, we are.
And your lifestyle isn't dependent upon your money and your.
No, it's not.
Okay,
we're kind of frugal.
So that's the question. You're asking us I can't see that far ahead, and I actually have no idea how the markets will react.
Well, the markets aren't spooked about it.
That's right. They're
No.
not at all. I mean, when they get up there and they're in that little tit for tat in the Federal Reserve, the markets are like, this is just a Trump thing, and this too will blow over.
Yeah.
So the markets aren't. Well, look, it doesn't for you. It doesn't matter one way or the other. If you're worried about it, then lower your equity position, but don't go crazy. I mean, lower it to 50% or 55%. What you don't want to do is if you're reacting to information that you perceive in the marketplace is going to be negative, then it's okay. it's okay to move the portfolio around the edges as long as you don't bet the farm on it, because there's a good chance you're going to be wrong. And there's a good chance that you might be right. We don't know. We don't know.
Okay.
But one of the things that I would be telling you to do is, prior to when you start required minimum distributions, is looking at Roth conversions for your husband.
Yeah.
That's something that you can actually control and actually will add alpha or excess returns to an after-tax portfolio. Meaning,
And if you have any charitable contributions that you've done after, written a check or whatnot, consider using a required part of your RMD for that.
yeah.
You can actually do that at age 70.
So which is weird when they changed the whole thing.
Complicated.
So, but if you're worried about it, then move the portfolio, but don't go crazy, please.
Okay.
Yeah, I wouldn't.
Well,
I mean, I think in some ways you're kind of borrowing trouble if you're worried about what's going to happen a year from now with the things.
Obviously, there's. I shouldn't say obviously. I sense there's a dislike for Donald Trump.
You don't have to ask her to admit to that or not admit to that.
I didn't tell her to.
I mean, I have friends that are on such extremes politically. Like, last thing I want to talk about is politics with them. Either one, because
That's right. Oh, look. I spent
what? You don't love Trump? You're not a huge Trump.
I spent one weekend with a MAGA. I'm all in, and then the next weekend on the other side of the equation, like you couldn't get further away.
I have people in my life I love dearly that are on both sides. So and Nancy probably does too. She doesn't want to come out of the closet. So to
I'm
speak.
not a Trump supporter.
Okay, we got that. All right. Anyway, just don't try not to let this drive your emotion, your decision making. So if it does, just do it on a little bit.
Yeah, I do think it's important to have an independent Fed chair. But we're heading now to Ohio and talking with Janae. Janae, you're with Allworth Money Matters.
Hi, thank you for taking my call.
Yeah, glad you're joining us.
My husband and I own a construction business, and all of our investing is in real estate. So I'm wondering what else we should do for retirement.
And go ahead, Scott.
Construction, is individual homes? Is that primarily what you guys do?
He does just about anything, so commercial or residential.
And how many employees?
One.
And is that you or just him? Or is it,
basically, it's just him and one other guy he works with.
and they're on payroll. They're not 1099. So they are considered an employer or a contractor. Okay.
Yeah,
Okay. That and the reason we ask that is because whether you have, if you have employees, you have different retirement plans than if you don't have employees.
And if you ever do you contribute to an IRA now, or?
We don't.
And how old are you?
I'm 49 and he's 44.
And what's the approximate income last year? Not revenue, but income, the money that you actually paid taxes on.
Around 80,000.
And how much real estate do you own, like in dollar amounts? 100,000, 300, 500 million?
Between our house and our property is about 1.1. Then we have 4 rentals and a church, and they're about 800,000 in value.
And what do you owe on the rentals?
We own all of our rentals, and we have about 50,000 on the church and about 210 on our house.
And what's the interest rate on those?
Oh goodness!
You own a church? Is that what you said? The first time I thought maybe you misspoke or I misheard you, then you said it a second time.
Yeah, it was a COVID purchase. My daughter was getting married. It came for auction, and he bought it, and it will be an event center.
Oh, okay.
Oh, okay.
He's not a pastor / contractor.
No.
So
what do you feel your need is? I mean, just looking at
Wait, one second, Scott. What do you know what the interest rate is on those loans?
No, they're not super high,
Okay.
but I don't know what they are.
Okay, they were done in the last few years.
I mean, you've got $2 million of real estate and you've got $250,000 of debt on it.
I know, yeah, but they I wouldn't count that personal real estate. Well, she said land though too, so that means he is a contractor. He gets subdivided any day. I think you should start putting money into your into a company 401k or a Unikay or self-directed 401k for himself.
Or just IRAs for the two of you. Simple. That's the simplest thing.
That is the simplest thing. And the income is $80,000. And I would
Right.
go 100% total market.
Okay. So when you say a 401k, I thought those were only connected.
I don't
if you
think.
were,
I mean, I would recommend doing an IRA for the two of you before I set anything else up.
I think
Okay.
about this. Wait, 1 second, Scott. You have the 401ks are just as easy to implement today as an IRA. Plus, you can borrow out of them if you need to. Not that I'd want them to. How much money do you have in the bank?
We have 12,000 in our rental account and then about 9 in our business account.
You don't have enough cash on hand.
You don't. How about in your personal? Do you have any like emergency reserve? What happens if your husband has a serious illness or breaks his leg? Or
We do have disability insurance through MediShare, but that's about it.
You need quite a bit more in liquid reserves, especially for self-employed. And are you working outside the home?
No.
I think what's prompted this call? Because you don't have any. I mean, you've done a good job with all these rentals. You don't have a lot of debt.
We are getting older, and I just start thinking, oh, we should have been putting money in an IRA or something all of this time. And I don't really know anything about investing that way. My husband really likes the tangible type investments like property. So I just really don't know what else we should be doing, I guess.
Well, I like investing. So whether it's tangible, stocks, bonds, right? The investment doesn't know you own it. And the more diversified you are in your investment portfolio over the long term, the less volatility that you will have in the portfolio over the long term. I think,
And I mean, if you continue down the path of rentals, you're going to go from 4 rentals to 6 rentals to 8 rentals to 10 rentals. Suddenly, you bite yourself another job,
which is okay. She's 49.
Yeah, if that's what you want.
Yeah,
but you put some money in an IRA, own a total market index. You're now an owner of the largest companies in the United States, and you're going to participate with their growth over the long term.
And it's just good diversification. You need more liquid cash, though. You need more of a safety net there, too.
How much do you think?
At least $25,000. And you said you have some for the rental set aside. I think you said $12,000, then $9,000 personal. When I say at least $25,000, that's on the personal side, not on the rental side.
You guys are pretty tight on the rental, too. I'd be a little...
I would, too.
What happens if one of your tenants pulls all the appliances out and takes all the copper piping and...
She's calling from Ohio.
Happen?
They're all good people in Ohio?
Correct.
No.
Never happening like that in Ohio.
No, I agree with Scott. That you both... If you were sitting in my office, I would say... Let's get some more money in the bank. Let's do that first on both the rental
I would
and
agree
then
with that.
let's go do the IRA.
I'm a little nervous. Something happens and you don't have the cash, and now you're.
Yeah, if you had called and said there was $50,000 between the rental,
it'd be simple.
And I'd say do a Roth IRA and buy the total market, but I wouldn't. I don't think I'd worry about the Roth IRA until I got at least $50,000 between those two accounts.
Yeah, and I'd get that saved up before you go out and buy another rental, because it's going to be tempting to because that's what can really create some havoc in your financial life.
That can
get
derail.
Short on cash, and you've got the assets, and then Pat, I think I just use a basic IRA to start.
Yeah, but why not Roth? 80,000, 2 of them.
You'd have to run the numbers. I think I think you're probably right. I'd probably use the Roth IRA.
I'd probably.
Before we sign off, I want to let you know about a webinar we've got coming up. It's a case study in advanced portfolio optimization. Benjamin Abraham is one of our Allworth partner advisors going to be doing this. And what you're going to learn here, you're going to get a behind-the-scenes breakdown of our in-house experts and some industry-leading tools that helped a high net worth couple do several things. And this is a real-life example there. How they eliminated some costly capital gain tax with some smart tax restructuring, how they're able to build confidence through retirement income modeling, and how they're able to refine their portfolio to unlock some longer-term flexibility. So it's really kind of a rare look at how all things come together. The webinar is going to be Wednesday, August 20th at 10 a.m. Pacific, Thursday, August 21st at noon Pacific, Saturday, August 23rd at 9 a.m. Pacific. And to register and get more information, go to allworthfinancial.com/workshops. Well, Pat, I think that's all the time we've got today. As always, been good being here. We'll see you again next week. And if you like this program, give us a review, a rating, or whatever on wherever you get the podcast.
Share it with a friend. Thank you.
See you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.